Welcome to today's R&D webinar. We are excited to have you here today. If you have any questions at any point, please feel free to use the Q&A box located below. Additionally, for your convenience, we are recording this webinar. For those who may be unfamiliar with Sensiba, we are a leading accounting firm ranked in the top 100. Our services encompass tax, audit, and a broad range of consulting services, including technology and sustainability solutions. We take pride in being a certified B Corp and have been serving our clients for over 40 years. All right, before we kick off, I'd like to go over some housekeeping. To receive credit for this course, it's important that you actively engage by participating in at least 75% of the 4 polling questions throughout the webinar. We will have each poll up for 1 minute, so please be sure to lock in your answers. Additionally, for full credit, you must attend for at least 50 minutes. For internal attendees, please complete the course evaluation for the training and provide feedback post-webinar. If you have any tech issues throughout, any missed polls, or anything else regarding your participation, please communicate with us to get this resolved. And finally, credit will be issued within 2 weeks of the training date. All right, now I'm excited to introduce today's speakers. First, we have Colmar, a partner at our firm and leader of our R&D tax credit practice. We are also joined by Ariane Woods, Senior Manager and co-leader of the R&D tax credit practice. And together, they bring nearly 20 years of combined experience and hold engineering degrees, making them uniquely qualified to guide us through the latest updates on the R&D tax credit in Section 174. Now, with that, I'll turn it over to you, Cole.
Thanks, Louis, and thanks everybody for being here. I have to make a quick, unfortunate correction to what Louis just said. Actually, if we play the game of adding it all together, it'd be more like 40 years. So we've all been focused on this credit and everything that comes along with it for about 20 years apiece. So we're excited to be here with you today. I don't love the term presenter. Feels a little bit formal. We'd like it to feel a little bit like a conversation and really cover some things with you. Some of it is things that have been constant for years and years, right? Like what qualifies for the R&D credit and how. But then we're going to provide some updates both on Section 174, which how could we do a presentation about the R&D tax credits without talking about Section 174, and also maybe a little more focused this time on the disclosure changes and requirements that are here. So we've seen them coming, we'll walk through that, but now they're here for 24 and going to increase even more for the tax year 2025. So these next 2 slides are required for CPE. So that was the learning objectives, very similar to the agenda, which I also covered, but this is the order we'll cover it in, hopefully build up to, what is the credit, what qualifies. And I think this will be good. A lot of good coverage because we have clients and companies on the call from all over the place and have different levels of experience with the credit. Some people are here because they want to learn about the R&D tax credit. Some people are here because they need the CPE, and that's fine too. Hopefully you'll walk away with something you didn't know or something that you can use from this. I will also make another comment about our presenters today. We both have a little bit of a challenge in front of us. I have a porch rebuild going on outside my window, which shouldn't impact the presentation, but if it does, Louis is going to put me on mute, and then Ariane is coming to us by way of Maine, I believe, Ariane. So Ariane and I normally sit in Indiana, but she's traveling today, but was able to put this in her schedule and join us to help out on the webinar. So we're excited to dig in here.
This was listed third, but we're going to start with this one first.
Yeah, we're going to jump around here. Just keep everybody on their heels or on their toes. So what's the legislative update? When we talk about legislative update, what we're really talking about here, because we wanted to get it up front, is Section 174, the R&D capitalization. And we're going to get into more of the detail of this at the end, but many of you are familiar with something that we've had to do for 22 and 23, and is still in the tax code, unfortunately, as of now for 2024, which is that companies doing R&D, which we'll get into the definition of that, instead of receiving a current year deduction for all of that expense, must now capitalize and amortize those expenses over some period. So we knew when it was legislated that it wasn't going to go into effect, but it did. And then we knew in 22 it was going to get fixed. We knew in 23 it was going to get fixed. There was actually some legislation that passed the House early in January in 2024, almost the anniversary of that legislation being passed through the House, but it failed in the Senate, so it didn't get fixed. The IRS has continued to try to provide some clarity for taxpayers about how to comply with the capitalization, and that's what we've been working towards, and that's what you'll see later on in this presentation is what are some of the interpretations of that guidance and how have we been helping clients navigate those issues.
And at least as of when I checked yesterday, there was nothing in particular moving forward anywhere on this right now. So
yeah,
this
as of now, it's a bit of a black box as to when tax legislation will happen. We could stand here and talk about different perspectives on that, but I've heard people say everything from right away, the first quarter of this year, to more pessimistic folks that think it probably won't be until later in the summer, late summer, even the fall. So we'll anticipate it, but we won't expect it anytime soon, really. So now, back to the beginning. R&D tax credit, we'll get into the overview. This is the first poll, so if you're interested in CBE, please make sure you answer the polling question there. And I think you'll see, when you look at the question, there's no wrong answers. We just need to make sure that you're answering those polling questions. And we won't pause on there very long, but Louis will leave it up and hopefully active for a while for you to make sure that you're able to grab that polling question that we just launched. So R&D tax credit overview, getting into it. What is the R&D tax credit, starting at the beginning? So it's a general business credit. It's meant to reward innovation in this country. So the credit is set up to try to reward W-2 based employees. So when we get into some of the details, you'll see that you can generate more credit for the efforts of a W-2 employee versus a contractor, some things like that. But it amounts to approximately 5 to 10% back as a general business credit. We can only
Cole,
give.
I'm going to go ahead and mute you for a minute if you want to grab your headset. I'm going to ask you to mute. And then Louis, did the polling question go up? I don't see it.
You know, I am having some technical difficulties on the poll. Let me work on it back end and then I can launch it. I'm just gonna create a new one.
Okay, perfect. And then Cole, if you'll get your headset out so that we're not picking that up so much. As Cole indicated, the business credit, it's designed to reward innovation primarily for W-2 employees, but the net impact is 5 to 10% at the federal level. One of the fantastic things is the R&D credit is generally not restricted to the NOL limitations and AMT limitations. So you can actually, there we go, there's our polling question. So you can actually take your tax all the way down to 0 or near to it. There is a limit to credit carry forward of 20 years on the federal side. California, which is where a lot of our clients are based and headquarters is, there is an indefinite carry forward, so it never expires, although the federal and most states do not, in fact, have a carryback. And then most states have a credit. Actually, Michigan just came on the board starting for tax year 25. They've got what looks like it's going to be a decent credit coming out starting for tax year 25. And there's almost 40 states now that do state credit. So definitely getting good penetration no matter where you are. If you're in one or more states, it's decent odds that you're going to have opportunity to help offset state tax as well. Most of our clients are in California, and California is often more generous than the federal credit. One of the big things that we want to talk about. Oh, are you back, Cole?
I'm back. Still
Okay.
working on the headset, but until we get interrupted again, then I'll get that part going. So
I'll let you take this one over.
Talking about the payroll tax offset here, right? So we mentioned general business credit. There was some acknowledgement a few years back that we need to do something that enables startups, right? Whatever startups mean, we'll get into that, but to enable startups to benefit from a tax credit, because a lot of times they're generating losses, it's great to have an R&D tax credit, but if you're not paying income tax, if you're not generating taxable income, it's not real valuable. So they came up with the idea of being able to use the R&D credit to offset payroll tax. So it was increased recently in 2023. The maximum that you could generate and use to offset payroll tax per year was increased from 250,000 to 500,000. So that was a real benefit. And then the constraints that they put on it and how who's eligible as a startup is within the terms of the number of years that you've had gross receipts, as defined as essentially any income, anything on a tax return. I joke that if you tripped over $1 on the street and you put it in the bank account, like that probably counts. So there's no de minimis threshold, but basically you have 5 tax years to qualify, and as long as any one of those tax years does not exceed $5 million in gross receipts, the credit you generate could be used to offset payroll tax. So interesting to note, right? A bit of a detail in the weeds is the $5 million analysis is a year by year analysis. So if one year you pop up above $5 million and the next year, based on the timeline of your business, you would still qualify and maybe your sales were down a bit below the $5 million threshold, you could then qualify again to use the credit you generated to offset payroll tax. So another improvement that was made recently is employers can use it to offset the FICA, employer side of FICA and Medicare. So that I looked it up before this presentation because I'm always fumbling for what the total amount is. That's the 7.65% that employers pay. You can use as you go along, and I think of it in terms of like slowing the burn rate, right? So you can theoretically keep 7.65% of your payroll in the door each quarter until you burn through the credit that could be eligible to offset payroll tax. All right. So at a very high level, what is eligible for the R&D tax credit? Any new or improved products or processes. So a lot of times the product part of this makes more sense to people than the process part. The process part is typically in the manufacturing setting, right? How are we going to manufacture this? Faster, cheaper, better, production line, that sort of thing. When we talk about processes, we're not talking about business processes in a general sense. So Six Sigma type of activities, management functions, those sorts of things are excluded. But we like to highlight it's not just on the product side, it is the process side as well. Throughout this presentation, more and more you'll hear us talk about business component, right? And we try to stress when we're working with clients, we talk about business components. What's a business component? It's IRS shorthand for a project. There's a little more detail to be had there, but we won't spend time on it now. But essentially, when we say business component, it's what the IRS means by project. The credit is meant to reward things that you do to improve your products and processes. They don't have to be evolutionary to the world. They can just be they don't have to be revolutionary to the world. They can just be evolutionary to your business. So just because it's been done before doesn't mean you know how to do it in your business and doesn't mean that it isn't a worthwhile investment for your company. You can still potentially include it as an expense or use it as a qualifying business component for the R&D tax credit. The only requirement, kind of a big requirement, but you have to demonstrate that it meets the 4-part test. So what is the 4-part test? I think Ariane will cover that here in a few minutes. And then there are additional guidelines for software, which we'll also dig into, talk about internal use software, some of those things. And then also important to remember here, what is eligible? Talk about contract qualification. And what this boils down to is who is taking the risk in the R&D and who's maintaining at least a substantial right in the intellectual property. So while we always talk about the 4-part test, and that's the test you use and must demonstrate to tell if any business component is eligible to generate credit for in the R&D tax credit context. There's an additional 2 parts here, which is you have to be taking the financial risk and you have to maintain a substantial right to intellectual property.
And we'll touch on that a bit more too. So once you know what is eligible, the next thing is to start attaching numbers to it. And no matter which calculation method, it's going to be a percentage of whatever you spend over a set threshold. There are 3 different calculation methods. The first 2, traditional and startup, are based entirely on the combination of when your company started and when you started R&D. So the first year in which you have R&D spend and revenue, that's either the traditional or the startup. So whether you had business in 84 to 88, you have numbers then, or if you started later than that, that'll dictate, again, traditional versus startup. The next method is alternative simplified, and that does not have anything to do with sales, which is delightful because even when I started 20 years ago, that 84 to 88 period was getting to be an awfully long time ago to go find records. It only looks at your R&D spend. It's a little less generous, oftentimes, but as many companies grow, one of the things that ends up happening is the spend that you have at the beginning and the investment required to get the company off the ground for R&D is a significantly higher percentage than the maintenance. And so as you start having a product that you can sell, that's where the real money comes from. And your spend isn't necessarily proportional to what it looks like in those beginning years. And we'll help anyone walk through what makes sense. You also don't have to pick, again, between the traditional and startup or alternative simplified. You don't have to pick those year over year. You can just take a look and see what's going to work best for you that year, choose that, and move forward. A number of our clients can't calculate the traditional or startup, so they only take alternative simplified. Others, we take a look each year, and whatever makes more sense based on the history of the last few years is what we end up doing. As I mentioned, most states, near to 40 of them, have a credit as well. California is one of the most generous in the country, and it mirrors the traditional and startup method, and then the alternative incremental, which is great, again, if you just don't have the records because they don't have alternative simplified. I'm hoping at some point they fix that, but I've been hoping that for 15 years, so we'll see how that goes.
And I was just going to point out, Ariane, that that's really the slide that explains why we have to give a range for how much the R&D credit is, right? I always would like to be able to give people a real percentage or a real number, but unfortunately, it's one of those things like it depends. And then also like to point out here that depending on the calculation method, as companies go through product development cycles, the way the credit is calculated can, if you have a couple of down years and that you're using the alternative simplified method and you're looking back at an average of 3 prior years, even if you have a couple of down years and your credit is maybe a little less, it's almost like a seesaw or a teeter-totter where when you do come back into a product cycle where you're spending more, you generate even more credit based on having done a little less in prior years. So the mechanics of it all are very important to planning.
Yep, and tracking that so you have good data, even if you have a down year, is really important to being able to just validate what you got going forward. Cole talked about the 4-part test. There are 4 questions that Congress put in to say, does this project qualify for the R&D credit? The first one is called permitted purpose, so it's the why. Does this business component improve the fit, form, functionality, quality, reliability, efficiency, anything to just, again, bigger, better, faster, stronger for the product or the process? For a lot of our clients that are in manufacturing, engineering, computer science, a lot of what they're doing is making stuff more efficiently, making things use fewer resources, that kind of thing. Technological in nature is the next question. So we're looking for something that foundationally is related to principles of engineering or a hard science. Again, this one is not the tricky one right now. The third test is technological uncertainty, where at the beginning, you're uncertain as to the capability, methodology, or design of that business component. So you're not sure how to go necessarily from where you are to where you need to be on one of those dimensions. And the IRS has not generally been in the business of telling you how much uncertainty there has to be, just presence detection. This fourth one is critical. There needs to be a process of experimentation that is documented in some way that is basically better than guessing and checking. So we've got people with the appropriate degrees, background, or experience identifying different ways to solve the uncertainties that have come up, try things out, and iterate as appropriate. Initially, the IRS was taking a very bench scientist approach, like a lab scientist where you identify and test three hypotheses. And it took a few years back in the 80s and 90s, but they were eventually disabused of the notion that the real world acts like that because it's awfully expensive to try out, for example, 3 different rocket launchers to throw one of those really neat rockets into space. And so you need to pass all 4 tests. Again, it's presence detection. And once you say yes to all of those, we can move on. The IRS also, or Congress also listed a number of things that are not eligible. This is an incomplete list, but research after commercial production. So once you've substantially met the design goals of your project, that business component is no longer eligible. Once you've done something once, hitting copy paste doesn't count. A lot of the management functions, research in the arts, and then as we indicated earlier, funded research. And I want to touch on foreign research as well. One of the big keys here for foreign research is if you are buying something, a thing, and having it shipped to the US for testing, that's fine, that's a supply. What they've specifically said is, hey, you can't buy time. So if you're paying people that work outside the United States, for example, if you've got a software developer in India, or you've got a manufacturing center in China, which are very common, we're not going to be able to include those people for the R&D credits. So this is, again, an incomplete list, but one of the things we're very careful about is to make sure that all pieces of that are resolved for the project. Next up is things to watch out for. So as Cole indicated, for contracts, the phrase in the industry is rights and risk. So the person who's taking the credit for those expenses needs to have substantial rights to the intellectual property. It's not exclusive, but the minimum test is basically, can you make this thing again without having to basically pay for a license to do it? And then financial risk needs to be with the company taking the credit. There's been a ton of court cases this last decade or so around the financial risk and making sure that the company claiming the credit for those costs is the one on the hook for those expenses, whether it's successful or not. So if somebody's just paying for your time on a cost and materials contract, you're not going to be eligible to take that. If they are saying, hey, I'm going to buy this thing from you if you're successful, that would be your risk. We're going to get into this a little bit more in the next slide, but software is an incredibly complicated area for this credit. The US's R&D credit, the foundations of it were put together in 1983, and software was just not in the technology space that it is now. One of the things that they've seen a lot of, and through the 90s and the 2000s, and then was just how do we treat this whole space that was not under consideration when these rules were put into place. So the guidance, the audit guidance, when I first started working for basically the entire R&D credit was about 80 or 100 pages. The software guidance was about 160 or 180 pages on top of that to help them know and understand, hey, this is what we need to look for. There is an additional 3-part test on top of the 4. So for software, there is an additional 3-part test if you're using it internally. If you're just not going to sell it, it has to be for sale, use, or license. Otherwise, it is a 3-part test around innovation, significant economic risk, and not commercially available. The not commercially available, okay, fine. But telling a software company, is this a significant economic risk or is this innovative? It's actually a really hard thing to quantify or to qualify, because for a very small company, $1 million project could be potentially extremely risky for them. But if you have a Fortune 500, $1 million is budget test. And so there has not been a whole lot of guidance around internal use software. And then finally, as the last category that was not typically used until a few years ago is computer rental. When the credit came around in the 80s, it was really common that you're going to rent mainframe computer time from some business down the street. With the advent of personal computers and just the shrinking of computer power for about 25, 30 years in there, no one did that hardly anymore, other than just big research houses as far as doing that. Well, cloud computing has come online in a big way in the last several years. And so that's one of the big questions that we're seeing come up now is computer rental time for your cloud storage for your development environments and whatnot is another big issue. So we're starting to see a little bit more guidance requested around that particular topic. Did you have something, Cole?
I just wanted to add a little bit of color to drive the point home on the financial risk, not to backtrack too much, but you said there have been court cases in the last, number of years. I think there was one last year that I wanted to highlight. We didn't add to this slide, and I won't bore anybody with the name of it, but essentially what this court case did was the court clarified that they don't really care how you deem a contract as far as the terms, right? You can call it time and material, you can call it firm fixed price, you can call it really whatever you want. But they're not so concerned with what you call a contract or how you describe it. What they want to do is look through that to see what actually happened on the risk side in practice, in reality, right?
In the writing, like the contract.
And that's what I mean. So you can call it firm fixed price, but if you're really paying time and material, it doesn't matter that in the contract it says firm fixed price, because what the contract really says after it says firm fixed price, so that sort of thing. Having to read one level deeper, it's not enough anymore to just say, yeah, they're all firm fixed price, great, that meets the financial risk milestone. There's probably some additional due diligence that's needed in the evaluation of those contracts.
And I'll go ahead and add too that it's what is written in the contract. One of the things we see a lot of is companies that have an upfront payment of some sort. And so if you don't mark it as refundable in some sort of way, that can be considered a payment non-contingent, even if the company knows, hey, if we can't do this, we're going to refund it, we'll apply it to another project. If that's not written in the contract, it doesn't matter. And so we've seen this a number of times where the contract language for a specific project that you have with another company is going to override, even if business-wise, that's not how you're actually going to function because it's not good for business. So we do see that quite a bit. All right, a little bit more on the software side, and we've got 2 more slides on this. So to be considered not internal use software, it's being developed for commercial sale, license, or otherwise marketed to third parties or interacting. So if you're designing and developing the best ever ERP system, that's going to hook into production, it's going to hook into billing, it's going to hook into letting people on the shop floor do stuff along with the engineers. Fantastic. That's not internal use software in that particular case. If you're doing something that is much necessarily a smaller footprint that your company is going to use just you're not going to hook into anything else and you're not planning to sell it. So I've had clients that are making manufacturing software that just is how their machines work. We don't usually look at taking that because they're not going to be able to sell it, and it's not going to necessarily rise to these other questions. If again you're looking at selling something and this is something that was designed or developed for the commercial sale, license, or otherwise marketing to third parties. So at the outset of the project or the business component, that's what you're doing. If you are doing that, you don't have to worry about the next tests. Otherwise, so there's a couple of things here. Dual function is a business component, a software business component that is designed for both internal and external use. And so you end up looking at basically as 2 different projects in that case. So, hey, this component of that, the subcomponent of this project we're going to take a look at, it's non-IUS. The IUS component gets treated a little bit differently. And so we just don't have that extra layer of scrutiny if it is not internal use software. And then again, this is innovation, significant economic risk, and not commercially available. And as mentioned, that innovation is hard to quantify. How do you decide if something is innovative or not? Well, for some things, it's great. It's super easy to say, hey, this is an incredibly innovative piece of software. But other times, well, this is incrementally better, but does that rise to the threshold of innovative? Again, significant economic risk, $1 million. Like how much is $1 million depends on if your company is $3 million or 3 billion. Like there's a magnitude of scale that has not been clearly defined. And so one of the things to watch out for with software is figuring out, are you going to be subject to these extra requirements? And then how do you meet them?
I think that just getting this in front of people again helps highlight the how do we demonstrate these things, right? They're very hard to quantify. The IRS doesn't have any thresholds out there. They haven't put any information out about them, even not commercially available. How do you really document that, right? When we go back and doing a credit and then it gets audited 3 years later, what do they need to see there? So that's why we try to only include things as internal use software, in limited cases, and if there's truly a case to be made on all three of these fronts.
All right, we've talked a ton about what is and isn't eligible as far as the pieces that would go into it. Let's start attaching some dollars. The biggest piece for almost all of our clients is going to be the employee wages. This is the portion of wages allocated to their R&D activities. So if someone is spending 60% of their time doing R&D, we can take 60% of their W-2 box one compensation. One of the things that the R&D credit really does a fantastic job about is recognizing that R&D isn't just the people sitting at the drafting computers or at the lab bench or programming those softwares and those however many millions of lines of code they spit out every year. It's the first line supervisors in the technical capacity, and then direct support. And there's three main categories here that we see. It's the people who are putting together and testing prototypes, it's the quality team, and it's the people who are filling in the details on a lot of the electrical and mechanical design. You end up having specialists in those particular spaces. For a software company, what you're paying for is people. And so if all of your R&D team is in-house, we often see software companies that this is the entire footprint of their R&D credit. The next category is supplies. And this is things that are used up in the R&D process. So it's your prototypes, it's your testing. So for example, if you're building a machine, it's what you're using to test the machine. And then as more and more companies have gone to a software license model instead of buying a copy. So I'm going to date myself here, but I used to just buy Windows. And every 3 or 5 years, I'd buy a new version of Windows. Now every year I have to send them money. But those get used up. And those are no longer an asset on the books. They are they're prepaid. The next category here, similar to supplies, is that computer rental. Again, for a while, cloud computing was getting sort of bundled in with supplies, especially for software development groups. But it's more and more getting carved out. So you're looking at AWS, Google Cloud Services, whatever it is that you end up using, those expenses go there. The last category of the 4 is contract research. So this is when you're buying time from someone outside of your organization. So you're not paying them on a W-2, you're paying them on a PO, a 1099, that kind of thing. Note that because you're paying some of their overhead costs directly instead of indirectly, there's a reduction in the amount that you can include. So for most costs, it's 65%. So if you have someone, for example, hiring a software developer on a 1099, you only take 65 for those expenses. Some of the qualified research organizations, you can take 75%. And again, like if you're making an electrical device, you have to send out to UL or CSA. And if you look on the bottom of a lot of your devices, there's a little badge that says, hey, it's got your badge for it, that it's been tested, and it's not going to burn down your house. So as you go through those processes, you're going to have expenses associated with those costs as well. So again, it's the people that you're paying internally, the stuff you buy that gets used up, and the time that you buy from others outside the company. All right, our next poll, Louis, hopefully we have no trouble with that particular one. Oh, that one popped right up. Excellent. And then Cole is going to start talking about the disclosure changes that we've got coming up that have started.
I'll do the intro while everybody looks at poll number 2. Don't miss poll number 2 if you want CPE. So we'll keep going here. So we mentioned the disclosure changes. So the IRS has decided that they need some additional information to make sure claims are valid. They want to use it to try to ensure that, you know, they're directing audit resources in an efficient manner. So how long have we seen this coming? Truthfully, we've seen it coming for several years now. It started in a little bit of a different format. It started with some changes and some additional requirements for claims for a refund. So going back to any open tax year and making a claim that you missed the R&D tax credit and you want a refund, those requirements changed, and we walked through a little bit of a timeline here. But then it became clear that they wanted to cascade some of those changes, maybe some of the things they learned from that initial requirement for claims for a refund change to just the annual filing process. You know, why not ask for some additional information when we think this is what taxpayers should be doing to rightfully claim the R&D tax credit every year anyway. So we saw a draft of the proposed changes, and there was input given, and I think there was input requested, and I think there was a lot of input given by the industry.
Thousands and thousands of responses, such that they actually ended up opening up a whole new comment period so that they could make a modification and then say, hey, is this better? Like, it was 2 rounds of huge comments.
Yeah, so then this past summer, which is where I'll pick up on the timeline, June of 2024, they released their draft new 6765 that incorporated some feedback. I believe at that point they also requested feedback. And then they've got a second draft form released in December. And here we are in January of 2025. I think we know what's going to be required, and we'll get into that in very great detail here in a second. What's going to be required for 2024, right? For this filing season, and then what's going to be required next year for the next filing season, because that they have made part of this optional.
And as another note, both the form and the instructions are in draft form, at least as of end of day yesterday still. So there's still time for this to change again. So just as a disclaimer, this can still change.
Yeah, this is as of this morning. So here we go. And again, just getting into a little bit of the timeline, the released draft 6765, you know, the IRS's stated goal is to just a little more consistent and predefined treatment and reduce what they see as inflated claims, focus IRS resources, which I think conceptually all makes sense, right? The question becomes, how do companies get there, and how much additional burden is this really placing on them? And I think it depends, right? It is always the answer to a lot of these things. Like, it depends on how the company is doing it, you know, what the true level of detail is going to be required, et cetera.
So let's go look at some of those details. So here are some snapshots from the most recent draft. There's some questions up at the top around reduced credit. There's some additional questions from the IRS and other pieces, for example, the payroll tax offset and other stuff that comes through with that. And then asking about control groups, which I think is long overdue to make sure that you have a spot to say, hey, there's complications here. Sections A, B, and C are fairly straightforward. Those are just the actual computation of the credit. And so section D is where stuff starts to get new again. So this is an entirely new section where instead of just saying, hey, like checkbox, payroll tax offset, here's how much, there's a few more questions. As you can see, there's 2 checkboxes and 3 lines to say, hey, how much payroll tax offset are you actually taking and how? Section E is, again, not super unreasonable. We're talking about just looking for, hey, is there anything weird going on here that would make this look funny? Like, so set lines 39 through 41, fairly straightforward as far as acquisitions or dispositions, because those are going to make the numbers look different than they would have in the prior years. They want to make sure that you're not restating things so that you're being consistent. And then there was not a whole lot of traction around the ASC 730 directive when that came out about 5 or 6 years ago. But now that, because the IRS, the audit was saying, yeah, we might not necessarily rely on that for auditor appeals, this gives a little bit more validity to this. And so I'm expecting to start seeing more R&D credits coming in under the ASC 730 directive. Yeah. I'm going to backtrack to lines 37 and 38, however. So you're seeing on the form now, it asks how many business components are generating the expenses that you're including for the credit. That is brand new. We would see that under audit, but we never had that on the form before. And second, this question about officer wages that you're including on line 42. My suspicion is that they're looking for unreasonable compensation, but time will tell. And then again, what is the definition of an officer? Because there's state to state variation potentially in who is considered an officer of the company.
I just wanted to add, I've been joking, but not joking with clients on 37 number of business components. The answer is not one. So just that's the one thing that theoretically could be, but most likely the answer to how, you know, how many business components is not one.
Yeah. Section F, this gets into the piece of just, are you expected to do all of this? And then it breaks out what are the expenses, again, against those four categories, the wages, supplies, computer rental, and contract research, but highlighting that very top row of, are you required to complete section G, which is the one that is going to be, I think, a nightmare. So no one has to do it for tax year 24, thank goodness. Next year, everyone has to do it unless you are eligible to skip. So there's not going to be necessarily a lot of companies that are going to click the no, I'm not required to for 2025, because if you're taking the payroll tax offset and the reduced credit, a lot of times what that ends up meaning is it's not very valuable because you're not allocating as many dollars to the payroll tax offset. In addition, almost no one is doing that right now because of Section 174, because you can't deduct those expenses in the current period anyway. You also have to have gross receipts under 50 million, which not a huge deal for the current year, but also $1.5 million in QREs. When you're looking at 5 to 10% in federal credit, that's $75,000 to $150,000 in R&D credit, which is just, in the scheme of things for a lot of our clients, that's really not that much. If you are medical devices or you're doing AI research, you're going to blow through those numbers and you're going to be required to complete the next section. Otherwise, the rest of section G is not a big deal. It's just what's the spend and add it up. This is the part that's just not going to be fun for anyone that I'm really hoping changes. I've got snapshots here because I just want to share the magnitude of the pain that's potentially coming. But it's, what are you doing? How are you doing it? How are you spending your money? Listed out. Again, they want to know the top, the biggest projects you've done that covers either the 50 biggest or 80% of your total spend. And so you have to put them in numerical order. You got to list out that many. My expectation is they'll have some sort of mechanism for filing this electronically with multiple copies, but this is a lot of information that has not historically been needed until audit. And again, having this in a consolidated format is super nice for the IRS for review. Huge additional headache as far as preparing the forms, and the instructions indicate how long they expect you to spend to fill this form. That number hasn't changed in the last 20 years, and these credits have gotten a lot more complicated. So that is way out of date. So the next one, and I want to highlight this, it's a little hard to read, but the IRS wants to know on those wages, is it direct research, the direct support, or direct supervision? And what's your total for each of these business components? So now, in addition to just saying, hey, how much time is each person spending? Now you have to figure out what's their role. And if their role changes on different projects, for example, if you've got a hybrid engineer supervisor, now you've got to figure out how to allocate that for this. We would see that in audit fairly often, but again, this bringing it into every single form is going to be just terrible. And then finally, the next ones are just the sums. And so that's not a problem, but those first couple of sections are not going to be fun for clients to put together, or for clients to, or for the tax return preparers to complete. Anything else to say on that, Cole?
Oh, you got it.
All righty, well, this is your turn.
Great. What can clients do to prepare? Well, if you're already using time tracking effectively, you're in really good shape. So that's great news. Anybody out there doing time tracking, if you're thinking about implementing time tracking, now would be a great time in order to make it a little bit easier to fulfill these requirements. And if you have time tracking and poor compliance, or maybe no time tracking, it would be a great idea to figure out a methodology that helps people allocate their time to the business components, right? It's a couple step process. We have the business components. Now we need people to allocate time. Do we do that via time tracking through the year, or do we have maybe a survey approach? We have a survey approach that we can implement, and we do implement with a lot of our clients, that has their employees allocate their time through the year to particular projects. We might do that at different intervals, right? It might be once a year, it might be once a quarter. Really getting to a granularity, getting down as far as we can on the granularity, right? Because we know the IRS prefers time tracking and they really want it. That's not required technically, but more and more, as you've seen in the last few slides, that level of detail, we have to get close to it somehow. And then on the next slide,
Yep, working on it.
talk about a time tracking as an option. We know a lot of tech clients, software developers are not real willing to acquiesce to the need to track their time, but maybe there's a system that we can figure out that'll bridge that gap and will make it a little less painful and complete the credit, because it's a valuable savings for companies. $500,000 of payroll tax offset, even for a highly funded tech startup, a really well funded tech startup, is real money.
And then as another reminder, for if you're doing supplies for projects, throwing us something in the memo to say, hey, this is a supply associated with this particular project is incredibly helpful. Even if it's not an entire new field, just in the memo, this is the project that it goes to. At the end of the year, it means that we're not having to ask for invoices for, hey, what was this $27,000 about? And again, while the IRS is saying, hey, you don't have to do Part G, that 2 pages of information about every project. You don't have to fill that out this year. They are expecting everyone to be able to produce that information upon request. And so whether you have to fill that out or not, being able to make that is going to be a critical component to being able to withstand an audit, the scrutiny of an audit. Poll 3, please.
Poll number 3. And Louis, I don't know if this was scheduled for 50 minutes or an hour, but apparently we have plenty of content. So after people are done with poll 3, even if we're not quite to the next poll slide, if you just want to go ahead and launch it later, in case people only scheduled 50 minutes, we'll go a few minutes over here. I don't want anybody to miss the 4th slide if they need it, or sorry, the 4th poll if they need it, and we just messed up our timing a bit. So the last section here, the section 174 capitalization, we're not going to treat it as if people haven't heard about it. You've probably heard about it. You've probably experienced some of the pain, but this was legislated way back in the Tax Cuts and Jobs Act, and it didn't go into effect for 5 years, which was the 2022 tax year. Everybody knew that it was going to go away, and surprise, it didn't, because everybody knew it was going to go away because it's painful, right? So if you're spending on R&D in the current period, typically, and for 50 years, you've been able to take that as an expense to your business in the current year, and you don't pay taxes. Now you're required to quantify the section 174 R&D and capitalize it, spread it out over a period of either 5 years or 15 years if it's foreign R&D. When you dig into the details, it actually gets a little bit worse than that, because it's a mid-year start, which means in the first year you only get 10% of your domestic expenses that fall into section 174 and 3.3% of the foreign. So it's in a way it's 6 years, but some of the expenses here, and we have a little graphic that explains the relationship between section 41 and section 174. However, as I explained to clients, they're not wholly related, right? So one doesn't always follow the other. If you have section 41 R&D credit costs that you're claiming, you certainly have section 174 costs. But just because you might not be claiming the R&D credit and you haven't looked at it in that context before, doesn't mean that you are relieved of the obligation to identify your Section 174 costs and capitalize and amortize those relative to this tax law change.
Yep. Section 41, the R&D credit is optional. So credits are optional, taxes are mandatory. So that was the big change for a lot of our clients, is having to do these now.
Yeah, and then the footprint is bigger. So Section 41 costs, taxable wages, direct supplies, direct contract research. The 174 expenses are a larger set. They're a burden cost of doing the R&D, the overhead, potentially other parts of building rent and other just things that are associated with R&D expense as a company that have not been includable and are not includable for Section 41 R&D tax credit.
And one of the big things here is foreign. So for example, if you've got a design house, an internal or external, you've got a design team in India, you can't take that at all for the R&D credit. You have to take it for Section 174 capitalization.
Be included for Section 174. So further detail, just getting into some of the weeds of what has to be included for Section 174. We talked about the different types of wages, international R&D, all patent expenses, payroll expenses, utility, and allocate a reasonable allocation of utilities, rent, gas, electric, insurance, those sorts of things, shop supplies, things that might not have always been includable or we're able to attach for the R&D credit.
So typically for our clients, we see if you're a startup and you've got only people in-house or supplies, and you don't have a physical presence of an office, so there's none of these other costs, you can end up basically having your Section 174 footprint matches your Section 41. It's incredibly uncommon because, again, you're not like, there's no supplies, you're not doing healthcare, there's no pre-tax deductions basically. Once you get to a company of a certain size, you're going to be at minimum, generally at least 10% higher. And the further you go into having foreign costs and manufacturing and some of those other benefits that are just in some part required to have that technical workforce, it just adds up. And oftentimes we see generally about a 1.3 to 1.7 multiplier on the Section 41 costs to the 174.
Okay, I don't want to get too deep into this because we're running into time, but the important thing here is we have some revenue procedures, we have some guidance from the IRS on Section 174. We don't have actual regulations. We were hoping to have regulations, but we don't have actual regulations yet. It will be helpful when we do, but we don't know when that will be. So in the absence of those regulations, we're working relative to various pieces of guidance and our understanding of what the IRS's interpretation of the congressional intent was, right? That's the other thing to remember here. I always like to give the IRS some grace, and in many of these things, they're just implementing what they believe Congress has legislated and directed them to do. So possible changes, we talked about some legislation that was passed. We don't know if it's going away, when it's going away. Right now, 2024 is in place, just like 2022 and 23. One thing I think that is clear from prior versions of legislation is that the requirement to capitalize foreign R&D is going to remain. I think they're probably going to find a way to get rid of the requirement to capitalize domestic R&D. The foreign side of it, I think, is going to remain with us for quite some time. So we've heard rumors about the regulations and when they might be released. Who really knows? And then mentioning state conformity here, various states are doing various things. A little disclaimer that I can't vouch for the current validity of all this list, so don't use this as any sort of authoritative resource. But this
is potentially 2 weeks old on the news on this one.
This is what we put up here. So there's a mix of what states are doing relative to conformance to this R&D capitalization issue.
And as an interesting note, Indiana back in 22 was conforming with the feds and then was like, wait a second, we don't like this at all. And so Indiana is actually one that that went from conforming with the Fed to not conforming. Everyone else just didn't conform to begin with. And then just the way taxes, corporate taxes done, those other states don't have anything. I saw the last poll went up already as well. So today we've covered, I'll go through that quickly, easy peasy. We've talked about the R&D credit and what expenses are eligible. We've talked about some pretty big changes to the federal tax form that start for tax 24, the year that is for many companies, we're starting to get ready for filing those. And then for some even bigger changes coming for 25, we briefly touched on Section 174 and how it's bigger than the R&D credit and how that impacts companies. And then some of the changes to Section 174 that we're expect to happen at some point. If nothing else, the entire tax code needs overhauled starting in 26. And so that's sort of the like drop dead expectation for changes is in 2026. We do have a Q&A. There weren't any questions that came through in the chat that needed discussed, but if anyone would like to drop anything in there, we do have, it looks like 4 more minutes before we've used up the hour we allotted.
Yeah, feel free to leave early. We don't want to hold anybody up for the next meeting. I know if you're on 1 minute late for all of your meetings, you end up quite backed up by the end of the day. But thanks for joining us, and definitely if you have questions specific to your situation or things that you'd like clarified or want to talk about any of this, do feel free to contact me. I'd be happy to find a time and talk about your situation in greater detail and potentially figure out a plan to help you confront and then get over the additional disclosure requirements that are upon us for 24 and going to ratchet up a bit for 25 as well.